Welcome to the Baron Cabot podcast. I'm Mark Pearson, the Managing Director of Baron Cabot, where we specialise in UK property investment opportunities, catering to both seasoned investors and newcomers alike. In this podcast, we will be giving you market updates, investment strategies, and even review the latest developments in the UK property industry. This is the Baron Cabot podcast. Okay, so we've got Tom in today, who is one of our most senior members of staff within Baron Cabot. And obviously, Tom, your background was international property. You were working in Dubai, real estate and different places. And then now you specialised into UK property markets, right? And you moved over to Baron Cabot, specialised into investment properties for the UK market. What is it that got you into this market, and where is it that you've seen people make the most money or do the best out of real estate?
So in regards to sort of where I've seen people making money sort of across the UK, naturally people are drawn to sort of like your more established cities, which is what I quite like and what we quite like as a company, with your likes of Birmingham's, Manchester's, London's. But where we tend to sort of focus our attention, and personally in my own portfolio, is sort of like these, what we call like zone 2 or tier 2 areas, where you're just outside of the city centres and you're sort of ahead of the curve in that sense. So as that city expands, you know that that's going to ripple into those areas that you're in. Okay,
so is that where you're focusing your clients' investments into these sort of not quite exactly city centre, just outside city centre? And if so, why? Why are you looking at those as your preferred investment areas?
Yeah, absolutely. This is what we sort of advise to the clients. I mean, we normally take, say, somewhere like London as an example that's been performing now for many, many years. You look at how it grew from a zone 1 to zone 2, 3, 4, 5. You then see the money come into the cities like your Manchesters and your Birminghams, and you see the same sort of thing happen. Obviously, being from Manchester, seeing it firsthand, where there was a core city centre and now it expands into those further areas. So that's why we tend to sort of, as it becomes too expensive for those people to buy in the prime city centre, you then move them to the slightly more affordable area, and as it grows, they're then within that wave then, and you're getting a property effectively before the wave comes. And again, it's what I've done on my own portfolio as well. So personally bought in what you'd class as tier 2 Manchester.
Yeah, so tell us about that. So your most recent investments you've made in Manchester, right? So you bought with us in, you picked out a property and a project of ours, obviously. So you chose Pavilion, which is now Silkbank Wharf. Now it's been finished, it's renamed as Silkbank Wharf. What was it specifically in that investment that made you, obviously you've got a young family, you decided to make an investment yourself. What is it that made you invest in that specific development and that property? And then I guess, in the most recent transaction you've done, what were the things that you found different being the buyer rather than being the seller?
Yeah, in terms of that area, maybe slightly biased with it being Manchester, so I was always drawn to that. But then I used to live in that exact area. So when I finished studying, me and my friends, we rented an apartment on the exact same road that we were in, and it was just full of young professionals, people that you want to be focusing on, coming out of universities. They don't have a house deposit saved up, so they're working in the city centre. They want somewhere they can walk or take the tram or metro into the city centre, and that was sort of prime location for that. And this is right at the top of that sort of road, which either end of the road you've got the city centre, and on the other end you've got sort of like the business park and enterprise park down at Trafford, where you've got Old Trafford, and you've got sort of some of the biggest companies, Booking.com in Enterprise City and stuff like that. So it's quite we call it sort of like the corridor between it. And we've worked on quite a few projects down there, as you know, all of which we've seen huge amounts of growth on. Occupancy rates are very good. And again, from a tenant perspective, I was thinking, okay, how can I rent this out, or who would I rent this out to? And it's all people, again, working in the city centre. They don't want to pay the premium prices. So they take a 10-minute walk into the city centre or out of the city centre, and they're saving themselves a bit of money, but still accessible to everything they need to be.
Yeah, Pavilion was a great one, wasn't it? In the sense that I don't think we'd ever be able to bring anything to the market at that price again.
By far our fastest selling as well, without a doubt. And you mentioned there about what sort of the challenges, or what I found different being on sort of the other side of the table, if you like. And it was more so thinking about, okay, when it's your own money and you're putting it in, what do you want to think about, what's important? And it was sort of, when I was obviously trying to get my wife on board, it was like, okay, who do you invest that money with? Because it's all right doing the area and the sort of project, but it was more like developers and contractors and who you back to do the best job with your money. So that was something we put a lot of time in, and obviously, as you know, Domus very well, and that was a big factor for me personally, knowing that the projects they've done with us before always delivered quality, always delivered on time, and lo and behold, now the project's 3 months early, and it's paid off.
Which caused some challenges with the with early completions. As much as sometimes you expect an early completion to be a real positive, sometimes it can cause challenges.
It's an easier conversation to have it early than too late, though.
Yeah, absolutely, yeah. And Domus obviously being one of the certainly my favourite developers at the moment, or contractors at the moment. Domus, the level of detail behind them is incredible, isn't it? It's one of those contractors, they really care about the city, right? You know, everything that they're doing is, they live in the city, they're from the city, they're proud of the work they're doing. One of the best sites you can go on, right? You know, you go on site with it on a Domus development, and it sounds like a strange thing to say, but the small details matter, how tidy the sites are, everything's being done well, down to the guy that's sweeping up the construction site has done a very good job. Do you know? So
even having the opportunity, obviously, we had a launch for a new project in Manchester last week, and being able to sort of meet the guy who runs Domus was incredible.
Lee.
In terms
he's a good guy, right?
Like how he was talking about how they keep everything in house, so they're not. Like I think he mentioned it word for word. We're not taking door handles off a shelf in a shop. We're making them ourselves, and I think having that level of control and sort of overseeing of everything means the timelines and everything's in their hand. They're not relying, if there's a delay from something they can't help, it doesn't impact them. And like they said with the COVID side of things, because they have their own sites, it made no difference to them because they weren't relying on other people. And I just think that's something, again, that's massive. And I think it will be difficult then for sort of like your next investment to find someone who keeps up that level of quality. But I think that would be the biggest thing that I put, when you sit there and you've got, I've got 50, 60,000 pounds, what do I put it into? You then start to think, who do I put it into, as opposed to what it looks like? Yeah,
absolutely, and backing the right people. No, I agree completely. And then Soulboy, obviously, so Domus are their own contractor. They also, two of the owners of Domus are also the owners of Soulboy, right? What do you think of the new Soulboy projects? So obviously the one you bought, Pavilion, incredible project. And I think, you know, price-wise, as you mentioned, it's right. I think for any investor, it's a great thing to look for is what little areas, like sort of little, as you mentioned, corridors of value, or, you know, that Lewis says in The Office, you know, a corridor of value, but little areas whereby you can get a real good value between sort of two core areas, and obviously Pavilion's there. We're then looking at things, the Soulboy stuff that's coming on the market now. Obsidian, for example, that's more of an established area already because it's next to Blackfriars, which has done well. What's, you know, how do you view Obsidian comparatively to the things that you've bought?
I just think it's just naturally where the market's gone in Manchester now. I think when I bought Pavilion, it was sort of at a time where that sort of, like you said, that zone 2 and the city centre had sort of reached its peak. But now with the sort of workforce in Manchester, the big companies moving up there, your likes of Deloitte and Microsoft, people like that, naturally the sort of level of quality and expectation has gone up. And I think that's where Soulboy have perfectly sort of taken the market. You look at Waterhouse Gardens that they've done previously, that we've done, 55 viaducts. They've now tapped into that market. We're very used to seeing it here in Dubai, and you also see it a lot in London and these more established markets like New York. You've got those sort of premium luxury quality projects where these big earners who are moving up from London live in. And I think that's now what they've tapped into. So when we bought Pavilion, that wasn't so much the investment thinking then, but very much it is now, because people look at it and go, right, this is what Manchester needs. It needs something where you've got all your facilities and amenities. It needs something where you've got these high earners that are relocating up from London. Okay, we're used to that level of quality. What can we get now in Manchester for that? And they've done it perfectly. So it's elevated the city centre. I think obviously we both know Manchester very well. Yeah. And there was great projects there, but the city centre had sort of got to where it was at. Yeah. And now it's elevating. And even now you see every time we go back, it's new big glass incredible. Tower, new all this going up. I always remember it. I can't picture why, but my dad said years and years ago, he was like, we were just driving around Manchester and he just said, oh, in 15 years it's going to look so different because a lot of overseas investment was coming in. At the time, I was like, that's no interest to me. I'm 12. Like, well, I want to play football. But then now I literally look back at it and go, it's crazy.
It's probably the most exciting city in Europe at the moment, Manchester, I'd say. I don't think there's many other cities doing what Manchester
I get a very
is.
similar feel from Birmingham, though. Now when I go back, genuinely I do. When I've been back over the last couple of years and I've been and seen the projects for the handovers or taking pictures for the guys in the office, I get the same feel. Every time I go back, there's more going on. You see all the... I know it's slightly away from property, but you see all the big shops and the big restaurants and bars that you see in London and now Manchester, they're now coming up there. So they're ahead of the curve in that sense. And every time we go back now, we're seeing even the projects that we're working on in Birmingham, your likes of Belgrave Village, which is sort of with Galliard Homes, a predominantly London-based developer. They're now focusing the time and attention up in Birmingham for like 2-3 times in as many years.
I'm Barclay.
Exactly, and these guys are sort of normally on the point with what they're doing, right? And I think whenever I go back now, I see Birmingham, and it reminds me of Manchester 10 years ago. So that's probably where now, if you ask me, and I'm having the conversations at home about what we do next, I'm looking towards
start
Birmingham.
splitting your investments, start
100%.
looking at both cities. So on that, you at one point you were a first-time investor. Obviously, you've scaled and you learned a lot. But what would your advice be to a friend or someone at home, a first time investing into property? What sort of things would you be looking for? What sort of things would you do?
A couple of things is just sort of risk. So I think that's obviously why being in those sort of areas where you're near the universities and the big companies and near the transport links, you're naturally de-risking yourself from a perspective of obviously you always got to think worst case scenario, what happens if something does happen in those areas in the property market. Those sort of prime city centre areas will hold the value and hold the retention of occupants and tenants better. So I think risk is one, and obviously that goes back to what we were talking about with the developer or the contractor that you're working with. But I think over the last few years, I've been quite fortunate to work with some quite seasoned investors. And one thing I always find with them, and I look back on it, and these guys don't put all the money into one area. I don't, very rarely do I get somebody who goes, right, I want 3 in Manchester, or I want 3 in London, or 3 in Birmingham. You tend to find that they spread them across that. And that's the essence of investment in itself, right? You diversify, whether it be property, stocks, bonds, anything like that. But with obviously property, I think back to the clients who've bought 5, 6 from me, they might have a couple in one city, but then I'll send them next thing and say, I've already got Manchester, let's now look at Birmingham. Or I've already got Birmingham, let's now look at Nottingham or Derby, places like this. And I think that's good to use because then you are just protecting yourself. And again, that comes down to de-risking yourself. So I like the idea of 5 years' time, maybe hopefully a little bit sooner, you look back and you go, right, I've got Manchester, Birmingham, London, Nottingham. You've got the sort of major cities and you're de-risking yourself, diversifying.
Okay, great. So diversifying. What mistakes do investors make when they're looking in terms of from your perspective? What things when you sit down, you have that opening conversation with an investor and first time investor? What sort of things might they say to you that gives you a bit of concern about their thought processes or the way they're approaching investment?
I think the main one is, and there's a lad in the office who says it quite a lot, is the only mistake that you see people really make from UK, because UK property investment generally is relatively low risk as far as property investment goes, but the mistake that people make is they get too focused on the budget. So they come to us and say, I've got £100,000, I want something at £100,000. And they just think that because they see an advert, the property's worth £80,000, I can afford that, it must be a good investment. It definitely doesn't work like that. And this is where you've sort of got to change their mindset of thinking, okay, if I put that £100,000 into something, utilise the mortgage system and leverage it in the UK, I can then get a property that's worth 2-3 times as much, and then you're getting better value for your money. And as that property grows, you're making, that property goes 10%, let's say, you make 10% on the property value, not the money that you're putting in. And I think that's the sort of biggest thing, is trying to take people's mindsets away from. I always use the analogy of, look, if you buy a cheap car, you're going to have more issues with it. If you put £30,000 into a car, expect to enjoy it and get better sort of performance from it. So I think that's the main one, is trying to change people's mindsets of what you necessarily can afford doesn't necessarily mean it's going to work well. The sometimes just because it's cheaper doesn't mean it's better. It just means that less people have
bid on it, right? You know, some people, we see that a lot, right? Where people will say, you'll show them something in like a Pavilion Wharf, right? Here's exactly this area of Manchester we want to be in. It's got these amenities which retain the occupancy rate, keep the occupancy rate high. And then someone comes back with a unit maybe only 3 miles away, but a lot cheaper, and don't understand that it's also a lot less desirable. Do you know, so a lot less people that want it, hence why the prices are lower. I think the only other one that I'm noticing a lot is people that get overly interested in year one returns, right? You know, the yield in year one or the rental income in year one. What sort of mistakes are you seeing with that as investors?
Yeah, so we do it a lot. Obviously, the essence of how we work is we effectively want to take the emotion out of property, right, and make it feel like almost like a stock investment. So we rely heavily on cash flows. Okay, if you invest this amount of money, you'll make X amount in year one, it'll be worth X amount in 10 years and all that sort of stuff. So we see that a lot, and that's probably a lot of the questions we get asked when we go into sort of like a cash flow meeting. And they'll sort of say, oh, this is slightly lower than I expected. But naturally, you have to explain to them, especially as an international investor, you've got to build your footprint within the UK, right? So I always say your first year, same as if you opened a restaurant, same as if you opened a shop, is going to be your least profitable. Your rental income's the lowest it will ever be. Your interest rate's the highest it will ever be. And the gap just gets bigger over time then, because your interest rates become more favourable, and also your rental income, if you're investing in the right area, should go up. So your profit margin gets bigger and bigger and bigger. So that's a big thing. And I always say, look, if you're investing in property for 1, 2, 3 years, it's the wrong thing. Yeah. You're investing in property mid to long term. I would say minimum 10 years, 20, 30 years. That's what you want to do. And for us, a lot of the clients that we work in, being international, maybe they're investing from a market which doesn't perform so well, or the currencies are going through challenges.
I was going to say that. Obviously, if you're from UAE or from some places in Asia or Africa whereby the currency fluctuates a lot, you need, or Bali, right? You know, we've done some like personal investments in Bali. You know, we're not offering that to clients right now, but the yields are very, very high because it's a higher risk, right? So from day one, you need quick income because it's quite a lot of risk. Whereas with the UK, it's such a mature market that it's actually much longer. You know, investors aren't, because you're expected to continue making profit in 5 and 10 years, you know, the politics, as much as, you know, the politics might change over soon, it's pretty consistent, right? And nothing really changes a massive amount over a long period of time. So people do invest for 5, 10 years, and you know, with a reasonable level of judgment that in 10 years' time, your property is going to be worth twice the amount it is now, or near enough, right? Whereas in other markets, people have to get a rental income straight away. And I think that's one of the things that certainly international clients, sometimes it's difficult, right? To get the mindset to change from, you know, in your home country, you know, things might change in a year or two quite significantly, whereas in UK it doesn't. So you don't need that. You can look at much longer returns. You can look at capital growth, and you can look at more factors, right, over a longer period of time and protect yourself.
It always comes down, I just say, why? Why are you investing? And a lot of these, like you said, these international clients, maybe it is in Africa or in Asia where there's a lot less stability in those countries. They'll say they're investing for future generations. The future generations isn't 5 years down the line or 10 years down the line. They want something that then they can maybe pass to their kids in 30 years, or that's made them significant income over that 30 years that they can pay them through school, all those sorts of things. So having those, the investors answer the question and sort of saying, look, this is why I'm investing, that normally makes it very easy because they know what they want. Sometimes you just got to change the mindset from looking at it like that. Yeah,
things change, don't they? When you're about to put that money down, suddenly you get slightly more nervous and you start saying, oh, hold on here. You know, the long-term view goes out the window and you start looking at short-term. Yeah, so obviously a client's naturally going to be cautious coming in to speak to you. And, you know, the first thing I think clients probably think is, I can't give you my full budget because you're going to try and spend it, Tom. You know, like you're going to try and spend all the money that I have. And they're also going to be cautious about who they work with. Ultimately, you can Google UK property. Obviously, some people fall into the trap of thinking they can just go ahead and every company is going to be able to support you internationally, right? But what are the major traps that you see or you would advise against? How would you want someone to approach the first meeting, and how would you like someone to approach the first meeting, and why would you want them to approach it like that?
I think you want it to be a situation, you want them to feel like you're working with them and you're not either working for them or you're not sort of telling them what they should be doing. And I think the first meeting always, and this is sort of quite topical really, like the clients that I've had this week that have invested in the Obsidian.
Yep.
Perfect example of these guys, every single meeting we had, they gave away a little bit more. Now, ideally, you'd like to have all that information in the first one, because I kept saying to them, the more information you give me, the better I can help you with. Obviously, if you've got a problem, my job is to solve it. And it's good, and we laughed and joked about it of saying that. But in a first meeting, we as a company would probably approach it, and myself definitely personally, is more of like a conversation. It's finding out what you're looking to achieve, what you're already achieving, almost like a bit of a conversation in the pub with your friends or in a more social setting or a more casual setting, and having them tell you what they're looking for. And then they'll naturally just sort of start to open up. I always say it in our office, as guys who I think are more, they have more natural sales ability than me, but I naturally think people drawn to me, and I have good relationships. I quite like to think that a lot of my clients will look back at me and they'll check in on me. They'll check in when Dubai had the floods, they'll check in on my kid and stuff like that. So we have that friendly relationship of where, okay, they now know that I trust them and they trust me. And so the first meeting purely is just about giving them that information. And yes, you want to sort of prize into what you're looking for, what you can afford, but do it in a sort of sensitive manner and a soft manner of, okay, look, if you had this amount, this is what I can get you. And if you've got this amount, what are you getting already? And then they start to believe and sort of get on board with the fact that actually this person's not just trying to empty my bank account or spend all my money. They're trying to sort of help me grow a portfolio. Because I'll always say it, for us, and this is why we have, I don't even like saying it, an end-to-end solution. We have a sort of beginning to never-ending solution. And that's why we have, when we have the management company that are still involved, it means we're always involved in that process. So there's never, I use the saying a lot, there's never a case of where we say, right, good luck, I wish you the best of luck, and then you go separate ways. We're always involved in that, in a sense of, okay, you have a question in 2 years, should I remortgage in 5 years? You still pick up the phone to me. You still ask me those sorts of questions. And I think that comes across then, and that's when they go, you know what, this person's got my best intentions or our best intentions as a family at heart, which I think is important.
Okay, good. And then what lessons have you learned from investors? Obviously, we deal with a lot of very successful people. That's part of the reason they have the money to invest. What sort of, either within property or just wider, lessons have you learned from some of the investors that you've been working with?
I think the first one, and the main one I see, is obviously we spoke about it a moment ago, is diversification in terms of spreading that sort of risk and also spreading the profits. Because then, I don't know, it's almost like you get that, not only do you de-risk, but you get that excitement as well. If you read something about Birmingham that's really exciting, you're like, oh, brilliant, I'm in that market as well. So I think that's the first one. And that's when I sort of sat down last night thinking about this. I was thinking, if I think of all my clients who've done that, they're not in one city. I've never met anybody that's put 4, 5 properties in one city. Now, that's important for me because I would quite happily put all my money into Manchester from a sentimental value. And especially with the developers you see there, and even the contractors we work with, Soul Boys and Foreshores and Domus and people like that. It's very easy to do that, but I like the idea of the diversification. Also as well, in terms of obviously what I've learned from a lot of investors is, I know it was one client specifically, and it was sort of utilizing leverage, obviously. I had a client, he came to me, had $600,000, and I said to him, okay, we can look at this. And I was maybe sort of, look, these are in your budget. He was like, well, Tom, if that utilizes most of my budget, can't I just get something, a few properties cheaper, get 3 or 4 of them, and as they're growing, I'm making 10% on each of them as opposed to 10% on one property. And I was like, that's such a good way of looking at it, of knowing actually you're getting more for your money. You're still only putting in X amount. Your assets are all worth the same. And then at the same time, like I said, he's been able to de-risk himself of doing multiple cities at once. Explain
that a little bit more. So how did he approach the investment?
So he came to us, Tom, I've got this amount of money. He liquidated something here in Dubai. And I sort of said, okay, perfect. And he was drawn to London. And obviously, we always go through what we say with London. Great investment. It's naturally going to take more equity. So we looked at a couple of options that might have been £400,000 to £500,000. He was like, look, Tom, I like this and I'd like London, but I was thinking of something a little bit lower, a little bit lesser, and then I can spread my money across it. So then we then looked at it and said, actually, it's a great way of looking at it. Okay, so now he owns one in Birmingham, he owns one in the Pavilion, and he owns one in Kent, of where he's put basically somewhere between £100,000 and £150,000 into each of those. and then he's got mortgage the rest of it. So he puts in his 35%.
Yep.
The bank then pays the remaining for him. He's then got his tenants that are paying off that mortgage for him. He's still of age where he's working, so he's not relying on income. So that was never a thing of where he's going, I'll need £500, £1,000 a month in my pocket, because he's still working age.
Yep.
He then plans to retire in 5 to 10 years.
At which point we need the return.
We need the return on investments, but his gap between then his rental income and his interest rates should have significantly increased.
Yeah, of course.
And then he's making that pot then when he needs to, but at the same time he's spread his across 3 properties that have all, again, 3 prime areas that are all growing in different rates for different reasons.
Yeah.
And then that was a sort of eureka moment where I thought that's a great way of looking at it.
Yeah. And obviously, you know, if you put down 25% on a property as a deposit, for instance, with your mortgage, and it grows 5% in a year, your return on your money is 4 times that, right? Because you've only put, you know, your property grows 5%, you've only put down 25% of the value of the property. So your actual return on your invested capital is 4 times comparative to if you put in one property, it grows 5%, you get 5%, right?
And this would probably be what I'd say one of the biggest challenges. We work with a few nationalities and countries that don't like to utilize mortgages and leverages, and changing their mindset on that. They want to pay cash outright, and even if they get a mortgage, they want it paid off in 4 or 5 years, which you understand, and you've got to sort of give them sort of the grace on it. But at the same time, you just sort of educate them and say, look, actually, if you do this, if you're 40 years old, you've still got 10, 15, 20 years of working left behind you. You don't need this income right away. Yeah. You don't need this income.
And you can build a portfolio in 20 years,
exactly.
can't you?
And then by that time you are retiring, you've then built up 4, 5, 6 properties. Yeah. And then you're in a position where, okay, now you can retire and you're getting significant income from them all to do that. Something I'd be interested to ask you, Mark, as well. Obviously, you've been in the market considerably longer than me. That's not a slight of age, this there. But what do you see happening now over the sort of next 12 months? Obviously, we've seen a pretty significant 12 months with interest rates and prices growing again. Where do you see the next 12 months?
Yeah, I think we've seen the thing is with these cycles in property, and they are cycles in UK property. The cycles just you don't see huge fluctuations in pricing. Pricing sort of generally goes up, but it'll dip like 1% here and there. You know, so it's generally an upward momentum. And last year we had the issue with the inflation. You know, inflation was up globally. You know, energy prices up, which meant mortgage prices were up. Base rate was up. You know, as you well know, which means mortgage rates are up. One of the things that I guess frustrates me, but you have to understand it, is every cycle like this that I've been through, and I trained as a surveyor during the 2008 global collapse, you know, so I saw it. It was quite a scary time. But every cycle since then, Brexit, you know, COVID, all these different things, when property prices slow, rent increases. That's number one. But what happens is the press jump on property prices in the UK have slowed down, and then you always get these people that come out. And basically, this time it's different. This time, property is not going to jump up in the next year, right? And every time I've seen, every cycle I've been in, 4 maybe, they've always been wrong. It's very easy to say, well, you know, it's very easy to say how, you know, what's not going to work.
It's headlines, isn't it? They need the headline.
Correct. You know, and the press are always 6 months behind the data we're getting, right? So we know that at the moment, the market's picking right up. The data will probably is coming through. We're seeing it firsthand. The press will jump on it in 4 months, right? We know that, at which point everybody gets in the market, prices jump up, or should do. And I think the biggest challenge is obviously educating people that this time it's not different. It's, you know, you need very, very good evidence to prove to me that a 100-year trend has changed this year, right? You know, especially this year where it's, all right, you know, inflation's up a little bit. It's not, for me, it's the best time to invest. Prices have stayed stable. Yeah. If you can get in now, like you have, as soon as those mortgage rates drop, people have more disposable income. Every time we've seen that happen historically that we have data for, prices have jumped up. Yeah.
I think if you look back at it as a sense of, and again, it's something that we've spoke about quite in the training that we've done, and it's perfect way. It's almost like when you see the market slow down, it's almost when you want to jump in with 2 feet, right? Because if you imagine now you're competing, because maybe mortgage rates have been unaffordable for some people and it's taken a lot of potentially first-time buyers out of the market, you're competing with, let's say, 1 in 5 people now on a property, but you know the second, especially like you said, the press then do the big headline, mortgage rates drop for the most in 12 months or 5 years, whatever they'll come out with. What the general public then, they fly into the market.
Yeah.
You're now competing with 10, 20 people in every property.
Yeah.
Just plays into the factor of supply and demand, right? And then that's when you see the prices
it becomes
spike.
a seller's market.
Yeah.
And that's the challenge is right now is you want to invest when there's almost like a negative view, but all the data's positive. So all the things are saying, hold on, this is about to go, but people still aren't there yet. That's when you really want to be in. Obviously, if there's a negative mindset, but also the data doesn't look great, sit that one out. But right now, everything points towards it. And I think that's the challenge is that you're always having to say, look, it's going to be similar, and we're expecting to.
You mentioned at the start of that answer there about how sort of markets will, over the course of 10 years or 100 years, it's going to go up, but in that, you're going to see a few dips.
Yeah.
Would you say that's then why we would focus, or why an investor should focus in those sort of primal areas? Because if you do see a drop, you're protected more as opposed to your sort of further out areas.
I mean, it was always the way. Capital cities. You invest in capital cities, you don't get, you don't really see any declines because everyone wants to be there anyway. I think with the UK property, bigger cities, great. Much safer. I think if you're buying your first 1, 2, 3 properties, get your big cities. It's nice and easy. A lot of people want to go into small towns for the really high rental incomes, but then they don't recognize that the high rental incomes are there because occupancy rates may be slightly lower. So obviously your headline rent that you can get is high, but that's only if it's 100% occupied. I think the one thing that gets overlooked though is if property prices in the UK are stagnant because mortgage rates are high, people still move somewhere. And so what they do is the rental market in the UK is shot up. So as an investor, you're winning both ways. If the growth is slow, you're getting really high rental income. If the growth is high, your rentals are a little bit lower. So you're virtually always in that market. And the reason that is because there's just not enough property in the UK. We've just not built enough. We physically cannot build enough. We will never in our lifetime, I think, certainly within our careers, we will never be in a position where we have the correct number of properties in the UK for the amount of demand. Yeah. That's how bad it is. And people don't realize, globally, people don't recognize how bad the supply issue is in the UK.
I think that's what has, over the course of probably the last decade, like you see what we've seen with Brexit and COVID, I think that's why the UK market still stood the test of time. Because, like you said, it doesn't matter. And I always remember this, and it was a podcast a couple of years ago now, and the guy summed it up perfectly. He just said 3 words, and he was expecting something dead profound and in detail. He just said, man needs home. And it was just literally, regardless of how the world adapts and what's going on around it, if your rental contract was up in COVID, it didn't matter. You still needed to go and find a new property regardless of that. And you look at the other investments that you sort of would compete against property, whether it's crypto and bonds and I don't know, whatever else people put the money into, those are reliant on, or people can pull out of that and pull into that regardless of how technologically advanced the world becomes. Yeah. You still need a roof over your head. Yeah. You still need a roof over your head. We might have flying cars, so your Audi might be worth nothing in 5 years or 10 years, but then you're still going to go back to a home where you need that, and that's why I think property stands the test of time.
Exactly. And the thing is, as well, is that we didn't build as much because when the interest rates are higher, they are for builders as well, developers. Everything goes up. So yeah, I think that's the one thing that I would say is over the next 12 months, I'm very confident with the market. We're not always saying that, so it's not like we're always reasonably confident because whenever there's an undersupply, there's always going to be an upward pressure. The prices always want to go up, but they might not because of affordability factors, right? But that's where we're confident. It's such a good investment. And it's why I think all of us, we're in the industry and vast majority of our investments go into UK property. Do you know, so it sort of speaks for itself.
I was going to ask you, because I know it's something that you definitely do a deep dive into it, and it's sort of like mortgage rates. Yeah. And obviously we've seen that been a massive headline of all things in the property market over the last 12 to 18 months. Probably the biggest challenge that we'll have to deal with over the 5 years previous, bar obviously COVID and Brexit, but in this next 5 years, interest rates was a massive one last year. You had a lot of people who, when they see the headlines, they panicked. And if they're in an off-plan property, they panicked and everything like that. What do you see happening with that though now? Like what do you see over the next 12 months? Because we've already seen it come down slightly from the start of the year, which is great. What do you see? Do you see it continuing?
Well, yeah, I mean, it makes sense to. The reality of it is it's more likely to come down than stay the same or go up. We know that. You know, the Bank of England are saying they're planning to bring it down. Do you know, so the people who set base rates are saying they want to bring it down. So that you can't.
I think it benefits everybody in a sense. It doesn't. I always say clients don't really benefit. No one really benefits from it because even if the rates go up, you get less business from it.
Yeah, it just slows down inflation, right? So as inflation's reducing, and we're hoping, you know, June, July, we'll start seeing base rates coming down. Then again, whatever, September time. The reality is it's more likely to come down. And look, it's still investments, right? You're sort of when you look at all your investment, you have to put your money somewhere. You're guaranteed to lose in a bank account because just inflation, right? So we know you can't, if you have any reasonable amount of cash, you can't keep it in a bank account. You're looking at bonds and, as you say, anything else, all these other things. Crypto, which I think I've been particularly bad at investing in. I've not done very well out of that at all. But you know, with property, it's one of those where you go, well, it's solid, and as I say, what's the most likely thing to happen? Even the people that go, oh, you know, property, it's overpriced, and all, you know, your interest rates are up and all that. And then you say to them, okay, do you think property is going to be worth more in a year or 2 years? And even I've not spoken to anyone, even the people that are saying, well, I want to invest in Bitcoin instead. I've not seen one of them say that they think prices will be lower. Yeah. Because if you understand any fundamentals about the market, you know where it is. So yeah, I expect mortgage rates to drop down. They should drop down. If they do, and the likelihood is they will. Also, the second likelihood is people have more disposable cash. If they're renting at the moment, they will buy. So the rental market will shift into a buyer's market. As you say, you'll have, rather than 5 people bidding on a property, you'll have 20, which will push prices up. And people will argue, well, what if they don't have the money anymore? You know, post-COVID, all this sort of stuff. Well, you've got the data there. The reason UK property is seen as the most transparent market in the world and is voted as the most transparent, we have all the data. So the point being is that we know that people have savings. We know savings have gone up. So you know, and they move around, but savings from 5 years ago are up. So if you compare it to any other historical year that we've had, so long as those mortgage rates come down, the most likely thing that will happen is prices will go up, and actually will go up quite quickly, quite significantly.
So that being said, now if you had X amount of money to invest in a property,
yeah.
And this is probably because this is a conversation we have a lot, especially on the ground, is would you look at completed or would you go down the off-plan route? Because for me personally, the way that I've definitely seen it over the last 12 months, we've definitely seen more of a shift. I would say normally we have a bit of a split, it's relatively even with investors. Definitely see more people lean towards off-plan, and I definitely think that's because they see the value in getting the best of both worlds. Like you said, you're tying a property at today's prices, which again, you know, in a year, 2 years, 3 years time, it's going to be more affordable now.
Yeah.
But they're looking at the mortgage rates and they're hearing the reports that it's going to come down. Bank of England is saying it's going to come down. You start a mortgage when that property is completed, let's say in 12 months, you're getting the best of both worlds in that sense. Would you go down that same route?
Yeah, I mean, obviously price dependent.
And I also say with off-plan as well, it's developer dependent as well. You need to make sure you trust and the track record is good enough.
Yeah, if it's priced, if an off-plan's priced well, and it is today's prices, you know, that's one of the things you always got to look at, you know, where's it priced at. But if it's priced well, everything we're bringing out at the moment is a genuine discount on, you know, it's genuinely going to be priced higher by the time it's midway through build and completion. Those ones with Soulboy, as an example, I'd buy all day. The ones with Foreshore in Manchester, I'd buy all day. Do you know, all of these off-plan ones, if they're a decent developer, they've got the funding in place, they're well regarded, yeah, absolutely fine. I think I'd err on the side of off-plan at the moment because of those reasons. You know, over the next sort of 6-12 months, you know, I'm fairly confident rates are coming down. I'm bullish. We all are. Internally in our office, everyone's buying. Do you know, anyone that can buy is buying. So we're all predicting those to come down. But yeah, look, I think if you've got a very, very good discount or very, very good priced completed, I'd also be happy with it, to be honest with you. I'm quite happily at the moment. I'm happy to get into markets and not make any money. I'm okay to put money into my mortgage in year one because I'm confident where the market's going in year 2, 3, 4. So again, I'm not overly concerned, even if my mortgage rate is pretty high right now, because I know I'll remortgage in 2 years and then I'll fix in a 5-year once the rates are down. I've no real concerns because I'll get the property growth in that time. I'll make more from the growth than I'll lose on the mortgage.
Yeah, and which city would you be putting it into now?
Yeah.
I know you mentioned Soulboy and stuff.
Yeah, no, it's the quickest way to annoy one of our developers, one of the contractors. Look, I mean, so at the moment, central Manchester, I'm very impressed with, really, really like what's happening there. So if I'm looking at a higher budget, I'm looking there.
Let me do this. Take Manchester and Birmingham out of it, because we do most of our most investors want it. Take those out of it. And let's say London, because that's a different conversation. Where then?
Okay, yeah, I mean, London I think is good value just on that point, because I think it's getting very good value in London. Do you know, I'm liking it more. We went off it a little bit, didn't we? Because it was just priced. There was a lot more value to be pulled out of Manchester and Birmingham, whereas London's now, there is a lot of value in London, even central actually at the moment. So I do like it if people have the budget. Outside of that, I'm interested in these a lot more towns when the market's a bit more unpredictable. As you mentioned before, towns can be a little bit more difficult. But if you're a confident investor, I'm looking at areas whereby we're near big cities. We've taken on a new project in Newark. It's only a small one. You know, it's a really nice boutique development. We're running the whole thing. So, which means that we've got a lot more control in there for our clients, which is good because it's small. You know, we can help our clients. We manage the build. So in 10 years time, if there's any issues, we're managing it for them. You know, we've got that all sorted. So places like that, your lower price areas just outside of Birmingham, just outside of Nottingham, just outside of Derby, just outside of Manchester. All of these areas, your sort of tier 2 cities, over the next 5 years, will probably start looking fairly safe again, fairly happy with them. As I say, for the right investor, we have that in place. Also outside of London, commuter London's quite good.
Kent's been a good one for us. I know.
Kent, Kent's lovely.
Because I know sort of like geographically, it's quite a journey from London, but with obviously the train line again, which is, you look at transport links as probably the biggest impactor on property. That train line into London, 36 minutes it is into central London. It's massive. And then again, so we obviously preach a lot about looking at job opportunities in an area and what's going to do that. You see with somewhere like that, you've got the Newark studio, not Newark, Newtown studio generation, which is coming on Netflix, HBO, Prime Video, all bringing their sort of workforce, their major workforce in the UK to that area. Again, it's ticking those boxes of work rates, occupancy rates, accessibility to a major city. And again, people naturally know, a lot of clients, even international clients I've found as well, know a lot about Kent. Because when they've gone to visit to London, they maybe don't want to pay premium prices to stay in Mayfair. They then go and stay 30 minutes outside, get the train in, and they stay in an area like Kent, or they've got family in Kent. So that's been a good one for me, I've seen.
All these areas, decent.
Big one, obviously another one that I know you've spent a lot of time focusing into, and you sort of integrating it into our day-to-day life every day. It's something that I'm probably the worst at in the office, and it's technology. And obviously, so I'm shocking. I'm a fossil with it, but I know you're obviously massively trying to harness the whole sort of AI stuff and how that's improving the market or impacting the market.
Yeah, absolutely. I mean, look, the beauty of it, you're a bit young for it, but when we started, when I started in as a surveyor, and anybody that'll tell you we were kind of the last generation of still having to utilize we'd use a computer for some things, whereas obviously now everything's on the computer. So when I started out, this is how fast it's gone, and I do feel very old talking about it, but we'd call up estate agents to find out sold prices. We'd find out what stuff's renting. You had to be on the phone a lot. You were reliant on your network many years ago. So you'd call up if you were looking to invest in Manchester, where I was training. Someone would call you up because specifically they're trying to understand, and it's not just Manchester, it would be that part of Manchester, so they'd want to know, I was city centre. If someone, you'd call up another valuer or surveyor if you're looking at Stockport or Wigan or wherever else, so it was very nuclear, because you'd just know your market, and then obviously as time's gone on, now we have all sold prices online. We're able to predict things. So we've really got into technology because it gives us the best results for our investors. Being able to predict markets better is very important. We were talking earlier about what the press is saying. If we were a business that relied on what the press was saying, we'd be in trouble because we'd always be 6 months behind the trend.
Yeah.
We're on the trend, and we're now actually telling the press what they should be publishing. So as you know, we're having conversations, and the press will ask us information about the markets and what's going on. So obviously that gives us an advantage. It gives our investors an advantage. It helps us in the press, so we get more marketing out of it because we're investing in this stuff. But I think overall, client gets a better journey because we're constantly harnessing it. As you know, we brought AI into the business. We brought more protection mechanisms into the business, and AI is a buzzword. We know that, we're not using it lightly. What we're utilizing it for is price predictions. We're utilizing it for protection of the client. We're utilizing it to cross-check training, staff conversations to make sure the right information is being shared all the time. And as we progress, this is just going to get more and more and more important. So it's something that we want to be on the front end of. It's something that I don't think there's many companies going as deep into it as us right now. Certainly not in our market. Obviously, everyone keeps it quiet, I guess. So, but yeah, technology over time, and we're getting closer to it. One of the beauties of the UK market is everything's published. So if you invest in other markets, the challenge is getting the correct data. You're reliant on sometimes what the government's saying, sometimes what maybe the press is saying, and you don't know who's feeding the press those stories. Normally, the real estate market, telling the press, right, here's what's happening, but with no data. One of the benefits is we have all this data, and all of it's published in the UK. But the challenge is now there's so much data is pulling it all together and being able to take out the information that you need specifically. And this is why, as a client, working with you or any of the other guys, is one of the beauties is it's all based on fact. Irrefutable evidence is the basis of it. So, as technology goes on, we'll make that easier and easier for clients to access, so they can access it on their own. Obviously, currently we're having to share reports and things like that, whereas we'll certainly go a bit deeper into that. Welcome to the Baron Cabot podcast. I'm Mark Pearson, the managing director of Baron Cabot, where we specialize in UK property investment opportunities, catering to both seasoned investors and newcomers alike. In this podcast, we will be giving you market updates, investment strategies, and even review the latest developments in the UK property industry. This is the Baron Cabot podcast.